We have, I would suggest probably 4 of the smartest guys in the microcap space. And they're going to give you their top microcap pitch. So I'm going to do a quick introduction, but then I'm going to let them properly introduce themselves. Here we have Matthew Martin from Rivemont Capital. We've got Stephen Huey from Pembroke Capital. Ryan Irvine from?
Keystone.
There you go, Keystone Financial. And then Jesse Gamble from Donville, Kent. So we're going to start with Matthew. He's going to come up, give a pitch, and then you guys are free to ask any questions, and then we'll go one by one down the line. All right? So Matthew, take it away.
Thank you. So my name is Matthew Martin. I run the Rivemont Microcap Fund based out of Montreal. We have 13 million in assets under management. The strategy basically is to look for the most undiscovered growth companies in Canada. So my sweet spot is to look for companies that are sub 100 million in market cap. And hopefully as they execute and they grow and they cross that $100 million threshold, they get on the radar of larger institutions, and we get the multiple expansion that comes with solid business execution. So the company I'll pitch today is called D-Box Technologies, DBO on the TSX. It's a Montreal-based company, actually. So the company has been around for quite some time, public for 19 years. I'm not sure, probably a lot of you are familiar with their flagship offering, which is the cinema seats that move around with when you go see a movie and you buy a D-Box ticket, the seat will vibrate and move with the action on the screen. So that's their most, that's what they're best known for. They do other things in simulation, training, sim racing. But I won't talk about that today because that's the movie theater business is really their core offering. So the business model, fairly simple. They sell hardware, which is the actuators that go inside the recliners, the movie theater seats. And then every time a new movie comes out, they code the movie, the action in the movie to be reflected in the experience you have in the seat. So that's a one-time work that they do to code the film, and then every time someone purchases a movie ticket, a D-Box ticket at the movie theaters, D-Box gets a royalty on the ticket purchase. So it becomes essentially, once they sell the hardware, they get embedded into all these cinema screens. It becomes just a recurring royalty business every time there's a new movie that comes out. So the situation, as I said, the business has been around for a long time. An activist started accumulating shares a few years ago. He got on the board of directors last year. His name is Daniel Marks. His goal really was to refocus the company on its core movie theater business. The company was trying to go into other markets, such as some consumer products that didn't have much success, so he killed a lot of these initiatives and really got the company to focus, cut costs, and become a high-margin royalty growth company that's profitable. The company also fired the management team earlier this year. Both the CEO and CFO were fired and replaced by a new team. So the new CEO who joined a few months ago, he's someone from the industry. He ran 2 film distribution businesses before. Very experienced, has all the relationships with the big movie theater chains. He's been buying stock in the market. He's very motivated to make this company a success. If we look at the current situation and valuation, you have revenues that have been growing 4 years in a row, 2 years of profitability. 2025 so far is off to a strong start. If you look at the financials, they had a very great Q1. I expect the company will do about $8 million in net profits this year, excluding some severance packages for firing the previous management team. So I think it's trading on about 11 times earnings right now at 90 million market cap. They have net cash on the balance sheet, 9 million in net cash, so great balance sheet as well. To me, it seems pretty cheap, 11 times earnings for a company that's high margin royalty business with strong tailwinds in its industry. They're embedded with the number 3 and 4 movie theater chains in North America, which are Cinemark and Cineplex. They still have yet to work with the number 1 and 2. So I think this could be a catalyst for the stock eventually if they announce a new business relationship with one of these large players. Other than that, I just think we should watch for continued strong financial results. And lastly, I think the natural end game here is probably to sell the business either to a strategic or maybe private equity. So, and my guess is that it's probably what the activist on the board has in mind eventually for his exit strategy. So I think we might see a sale of the business for a nice premium over the next, call it 1 to 3 years. So that's my thesis.
Anybody have any questions for Matthew?
Onyx? What's Onyx? I don't know. The activist, you mean? Yeah. It's called. His name is Daniel Marks. It's Stonehouse Capital Management, I think. Yeah. So I'm not familiar with Onyx. So.
Any other questions? Matthew, thank you.
Thank you.
Steven, you're up.
I think you just push this when you want to go. It's actually Ryan. Sorry.
I'll just do Ron's company.
Sure.
No.
Trevor,
I got
thank you.
Cypher and then Dynacore, yeah.
Okay. Trevor just put some slides together for me here, so I'll just do whatever he put together. Sure, that'll work. I thought we'd highlight Cypher because it was a company we actually recommended here a couple years ago. Would trade about the $3.85 range. We like companies that can kind of replicate their success in one market, rinse and repeat, and do that in other markets. Should I introduce what we do at Keystone maybe first?
Absolutely.
Before I
That'd be a
just get
great
into
idea.
it? I just want to get right into it, okay? No, Keystone, we're independent equity analysts. We don't get paid by the companies we do research on. Our clients are individual investors and institutions that pay us to help them build simple 15 to 25 stock portfolios. We started 25 years ago in the small cap area of the market. We do a GARP, or growth at a reasonable price type model, looking for profitable businesses, good solid earnings and cash flow, good balance sheets that have great management teams and a reasonable growth path ahead of them. We don't just look at small caps, though. We look at every dividend stock in Canada. We also look at U.S. large caps. We look at U.S. small caps and Canadian small caps, all with that GARP lens, growth at a reasonable price, that we're looking for those businesses. Okay. I thought I'd talk about Cypher because, like I said, we like businesses that can replicate their success in one market and move into another. Companies like the Boyd Group, Expel, Hammond Power, or Cypher, which is a company we think is doing this now. This is a company that has the #1 acne treatment drug in Canada. Did I say acne? It's acne. Acne treatment drug in Canada. In about 2013, they had 0% market share. Today, they have 50% market share. They have bought, this is another wonderful topic, they have bought the leading head lice and scabies drug in the, which, I mean, we all like to talk about, right? When our kids bring head lice home, it's a wonderful time. Well, we don't, with this treatment that they have, you don't have to actually comb it out. If you've ever had to do that, it's not a fun thing. I have not, of course, because my kids are exemplary students that would never get head lice, right? But anyways, they have this. The incumbent in the U.S. market has about 75% market share. Now, they have about 23% now. We think that can flip over the next 5 to 10 years. They made this acquisition. So when we originally recommended Cipher, they had 50% of their market cap in cash, traded about 5 times earnings. Great growth, reasonable growth in the existing business, but they could then use that cash to fund an acquisition. They made this acquisition. I was talking to Matthew earlier. I said, typically when you see a company buy a business in the specialty pharma sector, they buy it, and it's from larger pharma, and there is limited to no growth. It's a legacy asset. Well, they were able to buy this product. Essentially, it's a product that they bought. It was a company, but it's a one-product company, really, and it has organic growth. In the last quarter, in the last 2, we see quarter-over-quarter organic growth in that drug selling into the U.S. It's not in the Canadian market yet. They are in licensing it into the Canadian market, so we should see growth there as well. Cipher has, again, gone up 300% over the past couple of years. On a forward basis, we think it's 20 times earnings. That multiple quickly comes down by the end of the year to about the 15 range. The last quarter, you saw earnings up over 110%. So its earnings are outstripping the ratio of the PE, so we like that. It's good growth at a reasonable price. The next company I'm going to talk about is another business who's trying to replicate their success in one market and grow their earnings per share by expanding into other markets. Dynacor is a really boring business. They are a industrial ore processor. They sound like a mining company. If they were a miner, we likely would not be having this discussion, and I would not be recommending them today. But they are essentially, they mine for, or they process ore for artisanal or small-scale miners in Peru. Now, that is an area where they have taken their processing plant from about 150 tons per day to 500 tons per day. It can go up to, it has capacity to go to 600. When we originally bought this, it traded about $1.50, $2. It's moved up to about the $4.50 range now. We thought we would have a single mill here and eventually sell out around the $5 range. Now, they have built up a ton of cash in the business, and they are now trying to replicate that success next door in Ecuador. They have also, we consulted with management, they've implemented a dividend. So 6 years ago, no dividend, put it in right at the 6-year mark. They've compounded that dividend at 23% annually each year. So that is great growth. Our effective yield on it now is 8 to 9%. We expect them to compound that dividend going forward as well. Why do we like the business? Well, it has some exposure to gold, but it's really industrial ore processor. But they have 14 straight years of profitability. Right now, about 45% of their market cap is in cash, and the growth is extending into Ecuador, where they bought a mill. They bought that mill there. It's licensed to do about 1,000 tons per day. This time next year, they should have retrofitted that mill and brought it up to about 300 tons per day. The existing mill, like I said, in Peru is about 500 tons per day. So this adds about 60% production capacity. Now, there's further goals beyond that in terms of growth. They're doing a test pilot run in Senegal, geopolitically risky area, but they're doing about 50 tons per day, and that should come online either at the end of this year or the first quarter. That 50-ton mill per day will not make money, so there'll be a drag on profitability over the course of this year. We think that's an opportunity. They're going to test that market. If that market is successful, it's new to that market, this model of having a mill and small-scale miners bring it to the mill, so it's new. It's not new in Ecuador. We expect it to be an easier market to enter in Ecuador. But in Senegal, they should be able to bring that online within a year. Now, if it doesn't work with the 50-ton mill, they will not bring it online. So it's a safe way, $4 to $6 million, spend on that market to bring it to market. But the growth of this business over the next decade, to the end of this decade, should be significant. It's not going to grow a ton. If you're buying it for what it'll do over the next 6 months, we think the real production that'll come online, it'll be a year from now. So we think it's an opportunity to buy, clip the dividend, and you're buying it at about 5 times earnings when you take the cash position out, and there should be the potential to have 60% growth in cash flow about 12 to 18 months going forward. So that is Dynacor. I don't know if there's another slide here. There is. there you go. That's the dividend, I believe. So there's the valuations. I think I already went through all that. But again, it's a good cash-rich business. It's 58 million US in cash in the bank. That's over 40% of the market cap. You're buying it at a reasonable price. And that's about it. Good.
Any questions for Ryan?
Right here. Pardon?
Federal Drug and Administration for cyber. Any problem?
No problems at this point. No, not from the FDA. No. Good.
Excellent. Thank you,
All
Ryan.
right, excellent. Thank you. Thank you.
Now is it Stephen's turn? Yeah, there we go.
Oh, there we go. Thanks everyone for staying for the last presentation of the day. Feels a bit weird in that I'm presenting a company that already presented in a way better fashion than I possibly could, and I'm staring at one of the directors of the company, so I'm going to get all the information wrong and
No pressure.
mess that up, right? So I'm going to try and do this a little differently. Instead of giving the pitch as the company would, I'll try and do it in a way where how I see the company from a buy-side perspective and why it's exciting. So first off, who am I? I'm Steve Huey. I'm a portfolio manager for Pembroke Management. We are more new to the micro-cap game, so to speak. I've known Paul for quite a while, but we come from small mid-cap land in Canada and in the US, so our history, the firm's been around for 57 years, we're used to doing slightly bigger cap companies. Still a lot of the things that you love in microcaps, entrepreneurial teams, undiscovered opportunities, but where we came from was a little bit more institutional, a little bit higher market caps and AUMs, but we have quite the fondness for this asset class too. So McCoy, I'm sure you are all in the presentations and don't need me to tell you what they do. What doesn't kill you makes you stronger is something I say a lot in the energy patch, because there have been lots of things that have tried to kill a lot of people and a lot of businesses, including McCoy. So I have a slide here in terms of just what I've seen in my career in the patch, which is a lot of macro and a lot of industry-specific events that were extraordinarily tough on businesses, extraordinarily tough on PMs who had to cover the sector and are no longer PMs because they covered the sector. So essentially, it's been a very difficult place to operate businesses and make money. But I think what's really interesting about companies that manage to persist and survive out of all of those nuclear winters is that there is a bit of an evolutionary game here. Whoever did survive had really good skill in terms of the management teams, or they had extraordinarily persistent business models that were able to endure those nuclear winters. And that's my view of McCoy. Is that I think I first met Jim in the 2000s. Jim is the CEO of McCoy, and if you look at what the company's managed to do in those intervening years where there was incredibly difficult cycles, quite a testament to the skills. So this slide I like a lot. It's a translation of what we do on spreadsheets in terms of the cash in and cash out of businesses. This just shows what the company has done since 2014 in terms of reinvesting in the business, doing shareholder-friendly things like paying back debt, buying back shares, paying out dividends. I don't need to tell you what McCoy is doing in terms of the technological transformation in the casing running business. You can see that in their presentation. What I want to highlight is how much capital that in a brutal market they managed to put to work in terms of playing offense and being innovative. That's a lot of money for a micro-cap company to go out there and disrupt the world. And I think we're just starting to see the fruits of those efforts, where they've been in the tong business since the 70s. But if you look at the percentage of revenues that is coming from newer products, smart products. If you look at the margin profile of the business in terms of the grinding up of the gross margins with these newer value-added products, it shows that even in tough times, they put money to work, reinventing and modernizing what is an incredibly dangerous and inefficient part of the drilling process, and winning share. So very impressed with the capital allocation through the doldrums. The other thing I wanted to highlight, I'll skip the product slide, the people slide. If you think about investing, you can make it really complicated, but I like to distill it to things that even I understand. It's backing the right people with the right business opportunity at the right price. So the people aspect of it, super important in small cap land. I think even more important in micro cap land. But I've known Jim for a long time. Watched this company survive and then evolve and start thriving in the current times. On the board, I mean, this is a big part of our underwriting process, is understanding who is overseeing the management team and offering governance. So Alex is in the crowd. I know another director from previous life, Kathy DeMuth, who was at ZCL. I bring that up because I think you guys were on the opposite ends of the negotiating table on the ZCL deal when they sold to Shawcor. But this is where having a history in investing in smaller companies is really interesting. I had conversations with both Alex and Kathy about McCoy before we put a dollar of our clients' money into the situation, and even though they had an interesting history at ZCL, they were both super excited about the opportunity at McCoy. I think that they represent shareholders well, will fight for shareholders, and so the governance here is well set up. This slide is essentially the underwriting slide, so you can assume that every number here is going to end up wrong, but as long as we're generally right, that's all that really matters when it comes to getting the stock right. I'm not sure that the math gets to the 3x that Alex was talking about in his keynote this morning. And it's also because the stock's up in the last week since I put these slides together. But I don't find that these assumptions are challenging, right? We're talking about double-digit revenue growth for the next couple of years, tapering to high single-digit revenue growth, margins expanding because of mix and leverage, 5x EBITDA multiple as a terminal number, getting us to 19% compounded. This is how we handicap situations. We know that we're never going to have the precise numbers right, but even though the stock has 10 bagger off the bottom, when I look at this from the lens of a small mid-cap investor, there is still a lot to happen here in terms of growth, multiple expansion through discovery, and we're super excited about the opportunity going forward. I'll cut my comments short there, and if there are any questions, you have an insider in the room.
Any questions on McCoy Global? There we go. Sean?
Where do you think the stock will be in 3 to 5 years?
3 to 5 years? So we're talking 29, 30. I mean, my target price is 3 years out. So if I just do the simple math that I've got another high teens, a couple years of high teens compounding from that 640 target price, $8-9. But again, this is accuracy, not precision. We want to be generally right. I think anytime you are trying to figure out what a stock is going to be, it's what's the earnings and cash flow per share times the terminal multiple. I still think McCoy will be a growth company. in 2029, 2030, when you look at the addressable market, you look at the possibilities of modernizing what is right now a very outdated process. So I think $8-9, if with good execution, is very achievable. With the EPA, there's always, it's the energy patch, so there will always be environmental regulations that are in place. In this particular case, I think this is a story where you are. It's not really an environmental story on the ESG side of things, but it certainly is a safety story. I'd encourage you all to go on YouTube and look up the casing running process. The old school way, you have people who are sitting on top of the rigs running casing. It's incredibly dangerous, very easy to lose limbs or life. And getting people out of that red zone on the rig it saves a lot of money and it saves a lot of lives. So from an ESG perspective, you're always going to have scrutiny with an energy services company. In this case, you're saving money and you're making the process a whole lot safer. So I think you can get behind that any day.
Stephen, thank you.
Thank you.
Okay, next up we have Jesse Gamble from Donville Kent Asset Management.
Trevor's going to help me out here. Thank you, Trevor. And Paul for having me. So I'm Jesse Gamble, co-portfolio manager at Donville Kent Asset Management with Jason Donville. What we're looking for is what we call compounders, and that can be of any market cap. But what we're looking for, if we think we found one, is how much growth are we getting per unit of price? And when you factor both those in, you end up owning a lot of small caps because one, if you find them early, they're usually undervalued, and if they're small, you usually can find growth earlier on. So the company I'm speaking about today is Intermat Technologies. It's a super old company. It was actually, the genesis was World War I. It kind of became what it is now, and starting in '97. And the reason we're presenting on it today is, I'm going to skip ahead, is what happened in the 2016-2020 period. So they had a lot of missteps over the years, and new management came in 2016 to a company that had 30+ million in debt and was losing money. As you would expect, the stock was trading like a bankrupt company. And they came in, fired a ton of employees, replaced management, replaced the board, right-sized the business. They actually got rid of $34 million in debt for $1 million because, again, the debtor didn't think they were getting any money. And they took the majority, the CEO acquired the majority shareholder outright as well. So why do we care now is on the right side, now they're net cash, zero debt, and on the other side, now they're starting to break on positive on an operating profit. So let's skip back. So what do? Is they map the world. And why do we care about that? We'll get into it, but they do it in multiple different ways, and they have multiple different software as a solutions to different markets. So I'll skip through to some examples, and you have a better idea of what I'm talking about. So under their prior model, and why they got into trouble was they had a ton of data. So they would have, say Vancouver, they would have a map of Vancouver, and it could have multiple layers, and if someone wants that, they would go, okay, here's the data, good luck. You get paid, here's the data. What they did now is they completely revamped that with their own API. So now they don't, instead of charging for a vast amount of data, they charge you for a point. You want a specific point, here it is, here it's in an API. You don't have to be technical. Before, you actually had to have your own technical teams interpret the data in-house. Now it's pull it up on web, there's your data, easy to handle, easy to understand. And then now that they have all this data, they've mapped it, now they can sell it many times over. So new model, new management team, balance sheet, and as you can see, the revenue and profit is inflecting higher. Now, for most people, if you start to Google around or jump into this, the number one thing that's going to come up is this massive Indonesia contract that they won phase 1, and there's 4 more phases behind it. So it's important, but I think today one of the main reasons, the two main points I'm trying to get across is it's a different business starting in 2020, new business refresh, management team, et cetera. And it's more than just this contract. So this is a massive contract. Intermap is roughly, as of today, 200 million market cap, and this contract was for $20 million. It is important, and the contracts behind it are 180 million, and they're, we think, in the lead to win those as well. So high growth, high margin from them with just this. Now there's risks involved, but why they're hiring Intermap for this? That's a map of Indonesia, and the red parts are 1 to 5,000 mapped, and the rest of that entire area is either unmapped or extremely limited. Okay, so now what's the specific need to be 1 to 5,000 scale mapped? I'll give one example. If you are an ally of the US and you want one of their aircraft carriers to help you out in something, they will not unless you have a map at 1 to 5,000 scale. There's risk involved. They literally cannot help you out unless you have your country mapped to 1 to 5,000 scale. So with what's going on geopolitically, there's Malaysia, there's Colombia, there's multiple other countries that are saying, well, the way the world's going, we might need help along the way, and so we kind of need this to happen. That's one reason. There's others with, if it's a high growth country, you need a certain amount of data to be able to say, yeah, we can build here, we can't build here, et cetera. So that's, and again, I'm going through this fast. I'll be outside after if you want to jump into anything in more detail. But the other part, so Indonesia is important. There's a certain amount probably priced into the stock already that they probably will win going forward, but there's a lot more use cases to their technology than people think, and that's why we like to really delve into a company and see what's behind, and insurance is one of them. So we had a call last week with an insurance provider in Florida that uses their data, that uses their software, and they say they can quote flood insurance 30% more accurately than anyone that's not using their data. And why that's important is because their technology is up to 2 meters, or a lot of times just 2 feet of elevation more accurate. So if you're quoting flood insurance and you're off by 2 feet, it literally has made flood insurance companies go bankrupt. So they're seeing plus 30% better accuracy using their software than not using their software. And we think we're fairly early on in this. And one of the reasons is insurance companies were very much against underwriting without boots on the ground. COVID happens, and just the way the world's going with technology, they're now okay quoting underwriting business through technology. And so we think the insurance side of this business, which is a recurring model side, there's a significant amount of growth and margin there as well. We spoke to the geopolitical side a bit. Then there's even 3D mapping for augmented reality. They had a video game developer that wanted a real scale map of a certain city. So think like if you were Grand Theft Auto and you wanted a legit scale of New York City and be exact in a video game, how would you get that? You need to get that data somehow. They have the most accurate data you can get. They sell them the data, they can map and go into a video game developer that way. Or for drone deliveries or for navigation solutions, they have a really good example in their IR deck. They do a lot of work with the DoD where a helicopter crashed because their map elevation was wrong. And if they were using Intermap's, it would have shown a 40-foot different elevation, and the helicopter would have seen that. So we think it's a more effective, more cost-effective solution. We can talk about other solutions that are out there and the pros and cons of each. So we'll go to risks. That is one. There is other technologies. There's satellites, but if you think about a satellite only gives you 2D data, and you have to map these things usually multiple times, and a satellite isn't stationary for the most part, so if you're going over, you have to wait for it to come around before you map again. It usually ends up being 10 to 20 times more expensive to do it that way and less accurate. What Intermap does is they actually have their own planes that have their own technology on the bottom, and they are flying over these countries with their own planes technologies and uploading themselves. Obviously, customer concentration, that's the major pushback. If they don't win this deal, how much is that's priced into the stock? But what I'm saying, I think there's more there than just that. And lumpy quarters, quarter to quarter. If you win a very big deal and then you have to wait a quarter or two to win your next big deal, it can be lumpy as well. And I'll go back to the top point, geopolitical. You are dealing with some countries. So the stock ran up, again, this management team in 2015, 2016, because they were supposed to win a large deal for the Republic of Congo. Funding wasn't there. Geopolitically, I think there was a turnover in government, and that deal never happened, but it got priced into the stock, and you can imagine what happened there. So all that comes into play. It's not without its risks. That's my quick pitch on Intermap.
Fantastic.